Hey guys, thanks for checking out my market report today. And my name is Mike. My report entails going over mortgage rates, and we do also talk a little bit about the stock market because they do kind of encompass one another. But mostly this is what affects mortgage rates on a daily basis. So without further ado, we'll kind of start off with the economic reports being released today. Today we got two HPIs, which stands for Home Price Index. The first one is the Case-Shiller year over year for the month of December. So November had a 9.1% initially year-over-year increase, but it was revised slightly higher to 9.2. Forecast was calling for 9.9% year-over-year increase for the month of December, and it exceeded that 10.1%. We also got the FHFA monthly home price index. Uh, November was at 11%. It too was forecast a little bit, or revised, excuse me, a little bit higher at 11.1%, and it came in at 11.4%. So we could see both indexes indicating more growth on a year-over-year basis in the month of December. We're seeing that expansion. This is kind of the hottest we've seen since around 2014. So this is good news for homeowners that are seeing a lot more appreciation in their homes. Last but not least, we got the Consumer Confidence Report that came out for the month of February. So January's report was revised. So it started off at 89.3. It was lowered to 88.9. However, forecast was called for increase to 90, and they exceeded that to 91.3. So let's jump ahead here to the headline news. Stocks are a little mixed today. Or for the most part, actually, they're down. I'm sorry. We've been having some volatility because we had Jerome Powell's testimony before the Senate committee here, and he does these on a semi-annual basis. And basically, they were just getting drilled about where everything is, see if there's any fresh ideas that were out there from the Fed regards to the new output that we're seeing from the economy, economic, from the vaccines being rolled out to lower cases to there's concerns in the markets about hyperinflation. So there's those concerns, and we're trying to get answers what the Fed's thoughts are on those topics. And essentially, he thinks this could be kind of a new era of where things are at. He knows even though there could be money coming into the market, we may not have this spike of inflation that the worries may not be uh, there as much. If you look back in the credit crisis, we thought we would have a pretty big spike in inflation from that without the government spending then, but it was pretty tame for the most part. So we'll have to kind of wait and see what comes up, but we do have some inflationary stuff coming in the stimulus bill, especially when you're looking at raising the minimum wage, stuff like that. But in any case, for the most part, it eased markets a little bit. A lot of markets were like the stocks and even mortgage-backed securities were down for a bit, and then kind of now been kind of settling in a little bit after his remarks coming in. So let's go ahead and jump ahead, take a look at the mortgage-backed securities and see what mortgage rates are doing. Right now, we're down about 13 basis points. As you can see, we were down a lot further. We pulled back a little bit, but we started the day even higher because we ended the day yesterday here down about 44 basis points, and we started the morning higher, and then we worked our way downwards. And since then, we've kind of scaled back a little bit. So right now, we're down about 13 basis points. Some lenders may have repriced for the worst since we're, depending on when they came out the rate sheets. This is enough for a little worse pricing than what we saw yesterday. Yields are up right now, are actually about the same as where we left off yesterday. We stopped right at this line here, basically. We tested this line earlier, but we're still at about the 1.36 range here. So we're not too far off, only, like a few hundredths of a point here difference between these two, but in that same range movement right now. So again, rates are a little bit worse today than what we saw yesterday. We'll see if we're kind of reaching a floor, hopefully. Hopefully those remarks will continue to resonate and calm the markets a little bit. But what's happening is stock markets are also looking at maybe buying mortgage-backed securities and bonds, primarily because with the higher costs, with the higher yields, it's creating more costs to borrowing costs for corporations. And with that comes less profits for them. So as a safety with the higher mortgage-backed securities and such, they feel that that might be a better investment. So we may get saved in that with a more influx of purchasing in mortgage-backed securities as people move away from stocks. So we may have that looking in the future. So hopefully we hit our floor and kind of work our way back a little bit. Now we will over time gradually increase rates, but we'll have our peaks and valleys going up and down a little bit in that process. So it'll be like walking up a pair, taking a yo-yo, a little child walking upstairs with a yo-yo, walking upstairs with the rates going up and the yo-yo going up and down in that same range of motion. So just kind of picture that out. All right, folks, I hope you guys enjoyed today. If you guys got any questions regarding mortgage rates or anything about mortgages, a little bit of background about myself. I am a loan officer. I do work with a national lender. I'd be more than happy to answer any questions you might have. If you guys need any reviews of what your or thoughts on refinances or purchases, or maybe need a pre-approval, I'm here. If you guys need any assistance in that category as well, so please feel free to reach out. You guys have a great rest of your day. Thanks so much for watching, and we'll see you in tomorrow's video. Bye-bye.